All righty, 9:01. Good morning, everybody. Thank you for hopping on for this month's Industry 30. I'm pleased to introduce Peter Willis, who's president of Stacey Braun Associates. The chapter's had a long-standing relationship with Peter and Stacey Braun, so I'm happy to have him on to talk about today's financial markets. You all do have the ability to unmute yourself, so if you have any questions, feel free to unmute or use the chat feature. And this presentation is being recorded and will be placed on the chapter's website if you'd like to share with your coworkers after the presentation. With that being said, I'm going to turn it over to Peter. Take it away, Peter.
All right, thanks, Rob. Good morning, everyone. When I was putting together this year's presentation, I took a look at what I said last year, and hopefully no one went broke with anything I said. I think I got a couple things right anyway. So with that, we'll move on and we'll talk about where the financial markets are right now, how we got here, and what we see going forward. If you remember a year ago, 2022 was just a disastrous year for basically every single type of investment. This year's been a little bit better, and we'll get into that in a moment. First of all, just a quick bio here of who Stacey Braun is. I realize not the most exciting name in the world, but we are a investment advisory firm, been around since 1977. We manage just shy of $4 billion. 96% or the bulk of our business is asset management. That is managing money for groups. 4% is financial planning. Of our $4 billion, 92% of it is employee benefit funds. So that's pension funds and annuities and your chapter's money. And then 8% is high net worth individuals. We're located right on Broadway up here in New York City, and we're 100% employee owned. So with that out of the way, let's just retouch on what happened last year. If you recall, as I said earlier, stocks were down double digits last year, bonds were down double digits. There was just nowhere to hide. And the reasons for that were widespread, but the biggest was that inflation was running at 9%. Federal Reserve wants 2% inflation, so that's not even close. In response to that high inflation, the Federal Reserve was raising interest rates significantly and quickly. The Fed funds rate, which is what the Federal Reserve controls, was at 0, and they took it up to 5.5%. That's fast for the Fed. Another problem last year was Russia had attacked the Ukraine. Oil was skyrocketing. Europe looked like it was going into recession because they get all their energy from Russia. You had China's economy slowing. China's important because, unfortunately, it's the second largest economy in the world next to us. And China, at this point a year ago, had this ridiculous COVID policy where, since their drugs and vaccines didn't work very well, they just kept everybody cooped up in their apartments. And then the other thing overhanging last year was that pretty much every economist there was predicting that this year, 2023, would be in recession. In fact, everyone was predicting we'd be in recession as we speak. Would start in about June or July and run through the end of the year. And as a reminder, as painful as this is to see, this is what happened last year because of those reasons. Standard & Poor's was down 18%. Growth stocks were down 29%. Value did better, but still down 8%. International was down 18%. But the really ugly thing was that bonds were down last year. Bonds are supposed to be the safety feature in a portfolio. They're supposed to do well when everything else is falling apart. And you can see the aggregate bond index was down 13% last year. Corporate bonds down 16%. U.S. Treasuries down 13%. High yield or junk bonds were down 11%. That was actually the worst year ever for bonds. A bad year for bonds used to be down 1%. Usually they're never down. So for bonds to be down that much was something the world had really never seen before. And then I just threw down a couple of miscellaneous asset classes. REITs or real estate was down almost 25% last year. Gold was down 1%, which makes no sense. When everything's falling apart, you're supposed to buy gold. Now that didn't work last year. And then Bitcoin, believe it or not, was down 64% last year. So this new asset that was supposed to do well in tough times did not do well at all in tough times. So last year, very painful. There was nowhere to hide. And luckily this year, there's been some bright spots. The good news is that stocks are up. Stocks are up double digits, about 15% as we speak. Bonds still aren't doing very much. They're down just slightly this year, so bonds still haven't been able to get out of their own shadow. Here's that same chart. This is through September. Things are pretty much the same today. You can see the S&P this year to date, is up 13%. Through last night, it's actually about 15.5%. Growth stocks this year doing very well, up 25%. Value up 2%. International up 12%. So stocks are doing much, much better. Bonds, you can see, better than last year, but still nothing to write home about, down about 1%. The only thing doing well is high yield or junk bonds, and that's because the economy is doing well. Bitcoin, you can see, has rebounded nicely there. You lost 64% last year. You made 63% so far this year. So that's been a bit of a roller coaster, and I would argue it's doing exactly what its proponents say it shouldn't do. You know, it's supposed to be stable and down 64% one year and up 63 the next. I would hardly call stable. So let's get into why stocks are doing well this year. In our opinion, it's due to three main reasons. And the first and most important is simply that, as I said before, every economist out there said we'd be in recession right now. Well, we're clearly not in recession. We have a 3, this says 3.8. It was updated as of Friday. We're now at 3.9% unemployment. So we basically have full employment. Wages are going up. And basically, if people are working, people feel good and they spend money. So right now, everybody that wants to work is working, and therefore they're spending money. So the first reason stocks are up is simply a strong economy. Second reason, in our opinion, that the stocks are up is there's still a lot of excess savings from the pandemic sloshing around out there. During the pandemic, Congress passed 7 stimulus plans worth about $6 trillion, just an amount of money that the world has never seen before. And to give you an idea, in 2008, which was the worst economy ever, other than the Great Depression of 1929, there was one stimulus plan passed worth $900 billion. This year, 7 plans, during the pandemic, 7 plans worth $6 trillion. It's an exorbitant amount of money. We figure that there's still about $2 trillion of savings sloshing around out there. A lot of it in local governments and state governments. They still have a lot of money that they're spending. Great story in the Wall Street Journal last week of a couple. It was 2 teachers, man and woman, who were 2 teachers. They made $150,000 a year combined. They got tax credits and direct payments during the pandemic of $46,000. So, you know, 2 people used to living off of $150,000 get $46,000. Even good Americans can't spend that money in a year or 2. So they still had a lot left. They were going on nice vacations. And we think that's a big reason why the consumer is still in such good shape. Third reason we think stocks are up, there's a new outlook on life since the pandemic. And that is people are doing more travel. They have more leisure time with the work from home. There's definitely a new attitude. I know we see it with our employees. And there's kind of a live for now attitude, and that all results in more spending. And that's what's going on. The stock market, although it is up 15% this year, it's a little deceiving. There's 7 stocks that basically account for the entire gain. And they're calling these the Magnificent 7. And you can see them listed here, and this is the gain for the year to date through September. Alphabet, which is Google, up almost 50%, Apple 32%, Amazon 51%, Meta Platforms, which is Facebook, up 150%, Microsoft 33%, Nvidia up almost 200%, and Tesla up 100%. These 7 stocks, all in the S&P 500, are what's driving the stock market. And again, if you don't have these 7 stocks in your portfolio, you're basically nowhere. So even though the market is doing well this year, it's a little bit deceiving, because if you don't have these seven, you're absolutely left out of the gains this year. So that's the reason, why stocks are doing well. Why are bonds still stuck in the mud? And again, in our opinion, the three reasons are, and by far the biggest, is inflation. The good news is inflation has come down from 9%. It's running about 4%, a little under 4%, depending on how you measure it. But the Federal Reserve's target is 2%. And the thinking out there is that it's going to be a lot easier to go. It was a lot easier going from 9 to 4 than it's going to be from 4 to 2. So might have a little sticky inflation here. And again, the Federal Reserve wants 2%. So it's got a ways to go still. Second reason bonds are down, huge government deficits. Yes, the government has always had deficits. I think the last time we had a surplus was in the 90s. But at this point, we're looking at $33 trillion of total debt. This year, the government's fiscal year, September, we had a $2 trillion deficit. That's up 100% from last year. So we doubled the debt in 1 year. The problem with that, the U.S. is obviously very stable, huge economy. But the problem is you're supposed to pay off your debt in good times. Well, we just had, a couple of good years in a row, and we are increasing the deficit at 100% a year. Interest payments for 1 year, $659 billion. That's up 87% in 2 years. So that's a combination, obviously, that we're floating more bonds and interest rates have gone up. So let's take a look at what's causing these deficits. It's really simple. Tax revenue since the pandemic is actually up 28%. So the government is actually taking in plenty of money, spending up 46%. Just really easy to see. Third reason, and obviously when you're running deficits, the way the government pays for those is they float bonds. So the higher the deficit, the more bonds they have to float. They sell bonds about every 2 weeks. They're doing a 3-year today. They're doing a 10-year tomorrow. They're doing a 30-year on Thursday. So the more money you need, the more bonds you got to float. More supply drives up cost and drives up yields. Finally, the third reason bonds are down is we think the Federal Reserve is going to stay longer, meaning they're going to keep rates high for a longer amount of time due to the strength of the U.S. economy. U.S. economy, almost 5% GDP growth last quarter, 3.9% unemployment rate, as we said, strong retail and auto sales, corporate profits are up, wages are up. No denying the economy is doing well. And we think the Fed and investors feel the Fed will keep rates higher for longer. We talked about the deficit. This is the interest paid on the government debt, since 1940. And you can see in the last 2-3 years, just exploded higher. 659, that's just the interest we pay on our debt. So obviously not sustainable. This is what we spend our money on as the U.S. government. Social Security, $1.4 trillion a year that we spend on that. Medicare, almost $1 trillion. Defense, $1 trillion. And the fourth largest expenditure right now is interest payments on the debt. So when you think about it, most politicians are saying Medicare, Social Security, and military are off limits, can't touch them. Quite frankly, it doesn't leave a whole lot. You have to pay the interest on the debt, otherwise you're going to default. We don't want to go there. So it kind of is a conundrum there. But the bad news here is that interest payments are now the fourth largest expenditure of the U.S. government. As interest rates go higher or stay high, and as they float more and more debt, that's only going to go one way. So something needs to be done there. So what is the Federal Reserve doing? As I said, the Fed was extremely aggressive. They moved the Fed funds rate from 0 to 5.5%. And what they're trying to achieve here is what's called a soft landing. A soft landing is when the economy slows down, but not into a recession. And because the economy is slowing, demand slows and inflation recedes. A soft landing is kind of Goldilocks, if you will, an economy that's not too hot, not too cold. Inflation that comes down, and therefore then the Fed can ease back and doesn't have to worry about raising interest rates anymore. So a soft landing is what they want to achieve. It's really hard to do. The U.S. economy is kind of, I always say, kind of like an aircraft carrier. You can't turn it, you can't stop it, you can't start it real fast. So there's a lot of, unfortunately, other outcomes you can get other than a soft landing. If the economy stays strong and inflation doesn't come down, the Fed's forced to keep raising interest rates. And the higher you raise rates, the more risk of recession. That's one scenario, one bad scenario you could have. Another scenario would be the economy slows down, but inflation doesn't come down. That's called stagflation. That's what we had in the decade of the 70s. And unfortunately, I'm old enough that I remember the 70s, and that was just an awful time. The stock market literally did nothing for 10 years. Bond rates were very, very high. Interest rates were very high. Economy did little to none. That's really not what you want. So it's difficult to achieve a soft landing. Sometimes the Federal Reserve is raising rates right when they shouldn't be. Sometimes they're decreasing rates right when they shouldn't. Just a little note here. The Fed tends to cut interest rates about 6 months after they stop raising rates. We feel their last time they raised rates was in July. We feel that will be the last. But maybe they don't cut for they might wait longer this time. Again, the higher for longer. So what's the effect? Why is the Fed raising rates, and what's the effect? And simply, they're trying to slow the economy down. And as I said, Fed funds rate from 0 to 5.5% over the last 2 years. The 2-year Treasury bond went from 0.7 to 5%. And these are big moves for bonds. 10-year Treasury was 1.5 2 years ago. It's 4.65 this morning. And here's the effect on consumers. 2 years ago, your mortgage rate was 3.4%. Today, you're knocking on the door of 8%. That's a huge difference. Obviously drives the cost of home ownership way up. It drives, what they're doing is driving the cost of mortgages, credit card, business loans, car loans, all these things, the cost of go up. And that's what brings slows down the economy. We feel that the Fed is achieving this. We feel that the Fed is making progress. Obviously, with 8% mortgage rates out there, the mortgage applications have come way down. As I said before, inflation's come down from 9.1 to just under 4%, so that's good. Resumption of student loans started October 1st. That should slow down consumer spending. Leading economic indicators have been coming down for about 6 months now. Consumer confidence is way down. Chinese economy is still slowing. Again, second largest economy in the world, so they're slowing. German economy is basically in recession. German economy is number 3 in the world. So if you have number 2 and number 3 going down, obviously that slows things. And finally, we have an inverted yield curve, which means that short interest rates, 1 year, 2 year, 3 year, are actually yielding more than a 10-year or a 30-year. It's a very strange phenomena. Normally, the longer the maturity date of a bond, the more interest you get. Right now, it's upside down, and that's a sign that a recession is coming. Before every recession, there's been an inverted yield curve. However, there have been inverted curves without a recession, so it's not a perfect indicator. So right now, the Federal Reserve is looking for slower economic news. So that's actually seen by markets as good news. This sounds kind of upside down. And then strong economic news is actually seen as bad news for the markets. And as an example, last week, we had some slower economic news. Only 150,000 new jobs were created on Friday. That's way down from previous months. The previous month was 330,000 jobs. And you saw the markets take off. They actually loved that. So bad news is good for the markets as of right now. Stacey Braun's outlook is right now we're actually hoping and predicting that soft landing. We think the economy will continue to grow, but at a slower pace. We feel inflation will continue to come down. We think that commodities, even oil this morning is down to about $79 a barrel. It was 95 about a month ago. Things like corn have come down. You see the supply chains reopening, so you can actually get goods easier now. And finally, we think interest rates are close to peaking. We think they're going to peak around 5%. Right now, the 10-year is in a range of about 4.5 to 5. We think it'll stay there and hopefully won't break out above 5. A lot of worries still out there, though. Certainly don't want to act like there's nothing wrong. If inflation were to stagnate or increase, obviously that would be bad. U.S. government shutdown, unfortunately, this seems like it's going to happen about every month. We're worried about this, but the continuing resolution comes due soon. You've got obviously unrest and war in the Middle East. China's economy, we've talked about, continues to slow. China threatening Taiwan would be awful. And another chief concern of ours is that the Federal Reserve keeps interest rates too high for too long. Again, as I said, it's an aircraft carrier. So if they keep rates too high and keep hitting the brakes, the economy could dip into a recession. Finally, I'm going to repeat this from last year, and that is the message I'd like to convey here is that it's the best thing to do is to stay in the markets. The problem is if you try and get out of a market, you got to be right twice. You got to know when to sell and you got to know when to get back in. And a lot of people have made a career and they've written books and movies and everything else by being right once. But it's really hard to get it right twice. U.S. markets always come back in time. And I'll show a chart to that effect shortly. And also now on fixed income assets, as I said 2 years ago, if you tied your money up for 10 years, you got 1.5%. Who cares? But now you can get 5%, and a corporate bond you can get 6%. So you can actually make some money in bonds. Famous quote, I know Albert Einstein is known for equals MC squared, but another famous quote of his was the most powerful force in the universe is compound interest. And again, that's another reason to stay in the markets. This is, I think, a great chart. I showed it last year, but I think it's important. If you put $10,000 into the market, January 1st, 1980, it would be worth 40 years later, $708,000 if you kept it there. I actually checked the math on these because I didn't believe it myself. That's the power of compound interest, as Albert Einstein said. If you thought, the world was coming apart and everything looked crappy and you decided to sell and you happen to miss the 5 best days over that 40 years, you only made $458,000. If you missed the 10 best days, so just 10 days over 40 years, you made $341,000 instead of $708,000. It's really amazing, just missing 10 good days. So staying in the markets, letting your money grow and compound is clearly the best strategy. This is the last 20 years, just to show you don't have to go back 40 years. Again, if you put $10,000 in the market just 20 years ago, that would turn into $65,000. Again, if you just miss the 10 best days, just 10 days out of the last 20, you'd only make $29,000 instead of $64,000. So pretty powerful evidence here that keeping your money invested and looking the other way during the bear markets is the best strategy. This is what I mean about bull markets last longer than bear markets. This is the blue is all the bull markets going back to 1958. The orange is the bear markets, and you can see again that the bull markets are much longer and much higher than any of the bear markets. So again, the best strategy is to keep your money invested. I'll end on one final note. I showed this chart last year. It still holds up. Keep in mind, I am a New York Mets fan, unfortunately. But it is actually bad news when the Philadelphia Phillies win the World Series. Every year they have won, the country has gone into recession. You can see 1980, terrible recession. Phillies won the World Series. 2008, second worst recession ever. Phillies won the World Series. Last year, the Phillies lost in the World Series, no recession. This year, Phillies lost in the NLCS. Everybody was predicting a recession, but it looks like no recession. So to wrap up, we do think that the Federal Reserve is close to being done here with their Fed hikes. We do think we are seeing interest rates peak. We feel inflation is coming down and will continue to. We think the U.S. economy is slowing. We actually think moving forward, we'll see more and more signs of the slowdown. I think you can now make money in bonds at 5% on the 10-year government. And hopefully stocks will continue to do well if the Fed is done and the economy continues to grow. And again, just last week was the perfect example. Everything looked terrible in October, with the economy slowing and wars going and then all of a sudden last week comes, you get some signs of slowing. You have the best week of 2023 last week for stocks, very powerful rally. So again, another reason to stay in there. So that's our talk for this year. Hopefully, in our opinion, if what we predict comes true, would be good for the country, obviously, and good for the markets.
Great. Thank you so much, Peter. And we do have you on the schedule for 2024, so we'll hold you to this to see how next year goes. But thank you very much for the presentation. Are there any questions from the attendees? You're welcome to unmute yourself.
Hey, Peter. Sorry, Charlie, did you want to go first?
No, you go first, Dan.
All right. Hi, Peter. Thanks for that presentation. That was great. I wondered if you could say a little bit about the commercial real estate market in particular. I think a lot of the members here rely on that market for service work and, sometimes renovation work and stuff like that. You hear a lot about work from home, turning that market on its head and these, not being able to service the debt with the leases starting to expire. So I just wondered if you and your group had any thoughts or comments about that particular sector of the economy as it might relate to these guys here.
Sure. Definitely not my area of forte. You guys probably know it better than I. We've been trying to avoid it because, obviously, we're in New York City, and it is definitely a shell of what it was pre-pandemic for many reasons. But, I walk up about 10 blocks up Broadway. I've been doing it for 32 years. And, there's, I'd say half the retail stores are closed on every block. So I think it's going to be tough. But they may be able to turn this stuff into other things. You read about, turning things into entertainment and stuff like that. I would also argue that if interest rates come down, that would be really good news. And some of the commercial real estate companies are actually doing okay this year, but I think it's more because the news hasn't been as bad as people thought it would be. But I think it's going to be a tough go, and you just read, especially in the cities, just again, I've had the same commute for 32 years, and what I've seen over the last 2 years in New York City is just not what I saw the first 30 years. I don't know why you'd want to be here. So probably not a great answer because it's just not my forte. But in our opinion, when we buy a bank stock right now, the first thing we look at is how much commercial real estate do they have, exposure do they have? I hate to say it.
Makes sense. Thank you.
Thanks, Peter. The one of the questions I had was kind of segue off of what Dan had brought up is, and I guess again, it's not your forte, but for the lab markets, have you seen that slow down as I have, or do you have any advice on medical lab investments?
We owned one company. We did sell the stock, which was Alexandria Real Estate. It's a REIT, and they owned laboratory real estate around, and it got caught up with all the what we learned. We thought, okay, it's medical, therefore they should be okay. It's not strip malls and stuff like that. And it just got caught up with everything else. They seem to throw everything in the same bucket. I'm just looking at the chart of the stock. As I said, we got out. Yeah, good thing we got out of it. It just keeps going down. So I think they're all caught up in the same, the same story. Unfortunately, seems like on paper they should do better, but I just think there's
okay. Yeah, it's just unfortunate that government doesn't look at these figures because they continue to spend money like drunken sailors with reckless abandon, canceling student debt. It's nuts.
I would agree, and not, you saw those charts, and again, the government has always borrowed money. We always will, and there's nothing wrong with that. We're the most powerful nation on earth. We're the safest, but you got to pay it back during good times. And recessions, we should borrow money, and then when the economy is good, you pay it down. And we never really paid it down except during the Clinton administration, but we get it lower, and that's what mattered. We have never doubled our debt during an economic recovery. That's just so. What would happen if we go into recession? We're seeing it. Finally, people are starting to say, I don't want any more U.S. government debt. The biggest buyers of U.S. government debt, believe it or not, are the Chinese and the Japanese. And the Chinese, for various reasons, but political, obviously one, have stopped buying our debt for the most part. And they don't need to declare a war. They could just stop buying our debt, and our interest rates would skyrocket. But something has to be done. You saw the chart. It's not, and I don't want to get. I always try not to be political, but it's not a question of revenue. The government has gotten more revenue as a percent of GDP than they ever have. It's up 28% since the COVID, but spending's up twice that. So it's not a path that can continue.
Thank you, Peter.
Welcome.
All right. With that being said, we're past the 30-minute mark. I just want to thank Peter again, and we will be holding this presentation again next November. I want to give a plug for our December 7th Industry 30 with Andrew McDonald at Fox Rothschild. He'll be talking about what union contractors need to know about the legal landscape. So I hope you all can hop on then. And with that being said, everybody enjoy your day. Thank you.
Thanks, Rob.
Thanks, Rob.